Hello everyone. In the Monetary Policy Committee decision which was announced for the month of December, we saw a status quo on interest rates. This was broadly in line with expectation, markets as well as ours. However, the stance of calibrated tightening continued in the vote of 5:1, with one of the MPC members voting for a change in stance to neutral. However, the bond markets in the last few weeks, which were probably reeling under stress of liquidity and general apathy in response to rising crude oil prices, did see a little bit of respite, and bond yields, which were at 7.55% at the start of the policy, ended the day close to about 7.45% or 0.1% lower. The additional factor which was announced today was the SLR cut, or the cut in statutory liquidity ratio over the next 6 quarters from 19.5% to 18%. This seems to be a move to free up some spare cash to the banking sector to be able to lend to the real sector. While there was nothing explicitly stated about liquidity, it seems to be fairly evident from the pace at which the Reserve Bank of India has been conducting open market bond purchases. It seems like even for the coming quarter, which is Jan to March quarter, seems like the open market bond purchases could continue. But for now, I think the markets would incrementally focus on how the inflation trajectory would pan out in the coming months. It is extremely good news that the Reserve Bank of India has drastically cut the inflation target, not only for the second half of FY 2019, but also for the first half of financial year 2020. This seems to be driven by the fact that we have seen almost 30% correction in crude oil prices in the last couple of months. Also, it's heartening to see that bond yields, which were trading at north of 8% just 2 months back, are today trading at sub 7.5%. Now that clearly for the bond markets is seemingly a V-turn, not really a U-turn in the overall sentiment. What could be the view, or what is the view going forward? As I mentioned, markets will continue to draw cues from domestic macro, which is predominantly how the inflation data pans out, and also how the global macro unwinds and its impact specifically on the US 10-year yields. As we speak, the US yields on the 10-year benchmark are comfortably sitting below 3% at about 2.95%. That, coupled with the policy stance that the FOMC will take ahead of the US interest rate meeting, is going to be a critical driver for bond yields going forward. For now, it is reasonable to say that bond yields have got a lid, which means that though there might be a range-driven market, the upward movement on the yields on an incremental basis seems very muted. On the corporate bond side, though we have seen elevation in yields, they have not come down at the same pace at which the government security bond yields have eased. Therefore, the spread between corporate bonds and government securities have actually widened. What should be the way forward for bond investors? We have been for long maintaining that it is patience and discipline in this market that will yield rich results, and rightly so. The past couple of months have been very tumultuous for the bond markets, and the one who sat down patiently through this unnerving journey seems to have emerged a tad victorious. This is relevant for bond yields. This is also relevant from a liquidity standpoint. Going forward, we believe that strategies like short duration, the medium term, as also credit oriented funds could be the way forward for investors to continue their fixed income allocation. The absolute yields on corporate bonds in India continue to remain at elevated levels, and when you do a relative comparison to the government bond yields, as mentioned, the spreads continue to be fairly lucrative. So we continue to maintain that a combination of the short and medium strategies and maybe some top up of passive strategies like fixed maturity plans could be the way forward. For now, I can say that bulk of the negativities on account of liquidity crisis seems to be behind us, but we need to, as investment managers, always try to take one step forward. Let me try and assure you that we will continue to prudently manage portfolios with risk-adjusted returns as the primary focus, not just return delivery to the end customer. We have managed your trust for over 2 decades now, and we are confident that we will continue to do that for you on a very prudent basis. Thank you for reposing faith in us. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.